Joining us, Alli McCartney, Managing Director at UBS Private Wealth Management. Good morning.
Good morning.
I guess these are some of your notes, but I guess everyone can feel that some of the enthusiasm for AI has dissipated in the last 2 weeks.
Sentiment is moving really quickly in this market, and as you can see from a trading perspective, it's largely moving along with the momentum stocks. The honest truth is that given where we are in valuations and given some of the lack of data and the opacity we see in the market, longest shutdown, there are a lot of reasons why we should have more volatility right now than we've had. So when you add the fundamentals, the lack of data, and then you put onto that what's happening in Fed speak, I think having some sort of breaks, especially after October year-end for a lot of funds and asset managers, sort of puking stuff back into the market to start their year over again, makes a lot of sense to me.
Okay, and Andrew mentioned NVIDIA, that could be important. But in terms of just the last reporting season, could you have asked for anything?
No, it was
better?
extraordinary. It was extraordinary, but from the same perspective, so are valuations. So I think that there's that push and pull, and the market, you mentioned NVIDIA, I think the expectation is that between the 5 of the 7 or 10, depending on how you look at the stocks that are pushing this market, I think, between that 2 weeks ago, those 5 reports, and NVIDIA, there is this myopic focus. If you look today, also if you look this week at the volumes that we've seen, probably because of a little bit of the timing and also because of the holiday in the middle of the week, volumes are low. So I think this is just sort of a period of digestion. I'll tell you that as a former vol trader, I love it. I've been putting new money to work for the last 5 days in most markets that you can imagine, whether it's gold, precious metals, whether it's AI, hyperscalers.
So you like
feeling good about it.
Safety zones, and you like the risk-on areas too.
So coming into this year, largely because of concerns about recession and then sort of political erraticism, if that's a word, and the waning dollar, there were a lot of themes that are also positive for the stock market, that are positive for assets like gold, palladium, you name it.
Okay, that's an interesting strategy, barbell strategy.
Yeah, so it has been more of a barbell than I have had in my life in portfolios, where instead of necessarily only having traditional fixed income on one side and equities on the other, there's been sort of more of a ballast of in my portfolios right now. Some of it is because of the market movement taking the relative percentage up. Gold up 65%, even with markets up, 10 to 15%. Yeah, it's the relative. But I have some portfolios that have between 5 and 10% of those 3 commodities right now.
Gold, palladium, and what?
Silver.
Erraticity would be.
What do you think of what do you think of this Bitcoin situation?
This is an interesting one. So it sounds to me like there are some fundamentals as well as technical things going on. So first of all, if you put to the side that it is not a stock,
right?
Whether you're any cryptocurrency you're talking about, the short-term correlation to the Nasdaq is pretty high, right? So this has been a major correction week, momentum going down. So that makes sense to me. There seem to also be some stories on the more technical side of sales coming out, of concern about some of the positive tailwinds and regulation. But to me, again, risk assets right now are taking a breather, which they traditionally don't in November. So I think is giving people pause to begin with for a lot of the reasons that we discussed.
But therefore, is there any part of you that says this is a dip that's worth buying? Or is there a part
absolutely.
of you that's
I don't
for
think
Bitcoin? Or do you say, oh, this has more to go?
No, from where I stand, and this is more on me than UBS at this point, I think of it as having the same issues and short-term headwinds as a lot of risk assets in the market. But I think when you throw into that things like the government shutdown, things like erratic and unpredictable policy, rising geopolitical tensions, increased spending and focus on resiliency and defense, that makes me even more interested in using those assets as a long-term diversification tool.
It's a good possible word of the year for OED, because erraticism does not does not exist. Eroticism exists. I don't think you meant that came up, and I go, whoa, that's.
Markets can be sexy, but that's not.
No, that's not what you meant.
Wow.
So I think you'd have to use two words, like the erratic nature. But we need a single word. So I think erraticism.
We'll take that today.
I'm going to nominate that.
I liked it. I thought it was a good word.
It was a good.
Yeah.
I looked up erraticity, and that's not. I don't think there is a word, Allie. So
now there is.
Yeah. Congratulations.
Let me add one thing.
You got to go on Worldwide Exchange and give that to Fred.
Oh, that can be my word of the day, and I can make it up. I like that. I like that. I spent yesterday evening at Delivering Alpha, and I want to say that it was a very interesting time in terms of momentum being challenged yesterday in the market. A lot of conversations about private markets versus public markets and AI circularity, et cetera. And I really left there feeling more bullish than I even came in. And that's with fully invested portfolios.
Give us the thesis.
Yeah, so the thesis was there's a difference between a bubble and what they were calling a technological supercycle. And I'll give everyone from Mary Erdos to Philippe Lafont to Bill Ford credit for that. The concept being that when we talk about bubbles and when we go relative to history, there are two major things that we're missing, maybe even three. The first is how few public companies there are to invest in relative to any other point in time and any other transformative and catalytic cycle. The second is that relative valuations now, if you look back at the height of the internet boom or bust, you're talking about sort of 80 times forward earnings. As Joe mentioned, forward earnings are probably going to be 10 to 12% this year, probably 7% next year, very skewed and concentrated in those hyperscalers who certainly have an edge in this race. But right now we're talking somewhere between 30 and 32. Right. And if you think about the amount of private wealth we have in this country that was catalyzed by all of those other transitional technologies, especially in our lifetime, the internet boom and bust, there is a lot of capital and there are fewer things for them to go after. So if you truly believe, as we were talking about yesterday, in how transformational this will be and how early we are and how few companies there are to ascribe this value to in the public market and how few economies understand it and are using it right now, mainly simply China and the US, then you can more than rationalize some of these valuations. Right.